Understanding Share-Based Payments IFRS-2. Hey everyone, and welcome to your accountant's channel. Today, we will talk about the IFRS-2, a set of accounting rules that deal with how companies record transactions involving their own stock. Imagine you own a bakery. You need a talented baker to create delicious treats, but you might not have the cash to pay a high salary upfront. So, you offer the baker some ownership in your bakery, shares of stock, in exchange for their work. This is a type of share-based payment. Here's the key takeaway. IFRS-2 helps us understand how to record these transactions in the bakery's financial statements. There are two main things to consider. What the baker receives: freshly baked bread. A fancy oven? These are the goods or services the baker gets. What the bakery gives up: a piece of ownership in the bakery, its shares. Fairness is key. IFRS-2 uses a concept called fair value to record these transactions. This means we imagine a situation where a willing buyer and seller agree on a price for the bakery's shares. In our example, the fair value would be the price someone would pay to own a part of the bakery. Equity versus cash. There are two main types of share-based payments. Equity settled. The baker gets shares directly. Imagine the bakery giving the baker a certificate saying they now own a portion of the business. This transaction is recorded by simply increasing the bakery's equity, ownership, and recognizing the baker's services as an expense. Cash settled. The bakery owes the baker cash based on the value of the shares. Think of the bakery signing an IOU to the baker, promising to pay them an amount based on the bakery's future stock price. This transaction involves the bakery recognizing a liability, debt, and the baker's services as an expense. The bakery will keep adjusting this liability until it's actually paid off. Vesting conditions. Sometimes there are strings attached to getting the shares. These are called vesting conditions. For example, the baker might need to work for a year to get full ownership of their shares. IFRS-2 has specific rules for how these conditions are considered when recording the transaction. Beyond the bakery. While our example focused on a small business, IFRS-2 applies to any company that uses shares to pay for goods or services. This helps investors understand the true cost of running the company and the value of the company's stock. Remember, this is a simplified overview. IFRS-2 has more details, but hopefully, this gives you a basic understanding of share-based payments and how they're recorded in financial statements. Thanks for joining me today. If you have any questions, leave a comment below, and if you still needs more understanding, keep watching. IFRS-2, Share-Based Payments, Level Up. Hey everyone, welcome back to the Finance Channel. Today, we're taking a deeper dive into IFRS-2, the standard that governs how companies account for transactions involving their own stock. Remember, this is like using shares of your bakery as payment to attract talented bakers. But catch up, because today we'll explore fair value, beyond the basics. Earlier, we talked about fair value, the imaginary price a willing buyer and seller would agree on for the company's shares. But how do we actually determine this fair value in different scenarios? Market-based approaches. If the company's shares are publicly traded, their recent market price can be a good indicator of fair value. Income-based valuation techniques. If there's no readily available market price, we can use models that estimate the future cash flows the shares will generate. Valuation by analogy. This involves comparing the company's shares to similar companies that are publicly traded. This requires careful adjustments to account for any differences. Let's get technical. Vesting conditions explained. Vesting conditions can get a bit complex, so let's break them down. Service conditions. The counterparty, baker, needs to complete a specific period of service, work for a year, to get full ownership of the shares. Performance conditions. These add another layer, requiring both service completion and achieving specific performance targets, increased sales, product launch. However, the performance period can't be longer than the service period. Accounting treatment. When there are vesting conditions, IFRS-2 uses a modified approach. Here's the idea. We estimate the fair value of all the shares granted, even if they have vesting conditions. We then adjust the number of shares included in the transaction measurement based on the likelihood that the vesting conditions will be met. Imagine some bakers might leave before their year is up, so we adjust accordingly. Expanding your knowledge. Real-world examples. Now, let's explore how IFRS-2 plays out in real companies. Case Study 1. A tech startup offers stock options to attract software developers. The options have a 3-year vesting period, but the company is confident most developers will stay on board. Case Study 2. A manufacturing company grants shares to its CEO with a performance condition tied to achieving specific profit targets. Here, the fair value might be lower due to the uncertainty of meeting the performance goals. Consider incorporating short video clips of interviews with financial professionals commenting on these case studies. Challenge time. Test your understanding. Let's see what you've learned. Imagine you're a consultant advising a company on IFRS-2. In the comments below, answer this question. A marketing agency wants to offer shares to its employees with a vesting period of 2 years. How would IFRS-2 impact the company's financial statements? Remember, there's no single right answer. Explain your reasoning based on the concepts we discussed. The learning continues. That's all for today's deep dive into IFRS-2. If you're curious to learn more, here are some resources. ISB website. Access the full text of IFRS-2 and related interpretations. Accounting webinars. Search online for webinars or courses that offer in-depth explanations of IFRS-2 and its practical application. Financial news articles. Stay updated on how companies are using share-based payments by reading financial news articles that discuss relevant case studies. Thanks for joining me on Practical Understanding. Keep an eye out for the next video, where we'll be looking into an exciting topic in the world of accounts and finance.